6 Social Security changes are coming in 2026. And if you listen to the news, they'll tell you it's all good. There's a COLA raise, a new deduction, higher limits. Everyone's acting like retirees just got a windfall. But here's what the headlines won't show you. 3 of these changes are quietly draining your Social Security check. Not through some new law, not through a benefit cut, but through tax traps that have been hiding in plain sight for 40 years, Medicare surcharges that can appear without warning, and a government clawback program that is right now seizing 50% of people's checks to recover money they never even knew they owed. And the people getting hit the hardest? The ones who think they're getting a raise. Today, I'm breaking down the 3 Social Security changes in 2026 that are silently shrinking your check, and 3 moves you can make right now to stop every single one. If you find this useful, type 1 in the comments. If not, type 0. Let's get into it. Worst change 1. The 40-year stealth tax. Here's a question nobody's asking. If your Social Security benefit goes up 2.8% this year, why is your actual take-home check smaller than it was 3 years ago? The answer is something called the stealth tax, and it's been running for 40 years without a single adjustment. In 1983, Congress passed a law that made Social Security benefits taxable, but only for people with combined income above $25,000 for a single filer, or $32,000 for a married couple. At the time, those thresholds were designed to hit roughly 10% of beneficiaries, the top earners, nobody else. But here's the catch, and this is the part that should make you angry. Congress never indexed those thresholds to inflation. Not once. Not in 1990. Not in 2000. Not in 2010. And not in 2026. Let me do the math so you can see what that means. If those thresholds had been adjusted for inflation the way your tax brackets are, the single filer threshold today would be approximately $77,000. The married threshold would be close to $100,000. Instead, they're still sitting at $25,000 and $32,000, numbers that were set when gas cost $1.09 and the average Social Security check was $460 a month. What does that mean for you right now? It means that in 2026, if you're a single retiree collecting the average Social Security benefit of $2,071 a month, that's about $24,800 a year, and you have even a modest pension, a 401k withdrawal, or some interest income that pushes your combined income above $25,000, up to 50% of your Social Security becomes taxable. And if your combined income crosses $34,000, up to 85% of your benefit gets taxed. Let me say that again. 85%. In 1983, roughly 10% of beneficiaries paid federal tax on their Social Security. Today, over half. More than 50% of everyone collecting Social Security is now paying federal income tax on benefits that were supposed to be their safety net. And the number grows every single year, not because Congress passed a new tax, but because they never updated the old one. Here's a real story that shows how this plays out. Margaret, 71, retired nurse, Pennsylvania. She collects $1,900 a month in Social Security. Her husband passed away 3 years ago, so she files single. She also takes a small required minimum distribution from her late husband's IRA, about $800 a month. Her combined income, approximately $43,000. That's not wealthy. That's not extravagant. That's a retired nurse in a modest house. But because of those frozen thresholds from 1983, 85% of her Social Security benefit, roughly $19,300, is now taxable income. At the 12% bracket, that's an extra $2,300 in federal taxes she never expected to pay. Her words from an online comment: "I paid into the system for 42 years. Now they tax me to get my own money back. Feels like I'm paying twice." She's not wrong. That's exactly what's happening. And every year, as inflation pushes more retirees above those ancient thresholds, the stealth tax catches more people. The raise they gave you isn't a raise. It's a wider net. The thresholds stay frozen. Your income creeps up, and more of your check disappears into taxes, automatically, quietly, without anyone voting on it. But if you thought an invisible 40-year-old tax trap was bad, wait until you hear about the Medicare surcharge that can appear on your bill without any warning. Triggered by something you did 2 years ago. Worst change 2. The IRMAA trap. Most people know that Medicare Part B costs $202.90 a month in 2026. That's the standard premium. What most people do not know is that this number can triple or even quadruple based on your income from 2 years ago. It's called IRMAA, Income-Related Monthly Adjustment Amount. And it is one of the most punishing financial traps in the entire retirement system. Here's how it works. Medicare uses your modified adjusted gross income from your tax return 2 years prior to set your premium. So in 2026, Medicare is looking at your 2024 tax return. If your 2024 MAGI exceeded $109,000 as a single filer or $218,000 as a couple, you don't pay the standard $202. You pay more, significantly more. Let me walk you through the tiers because the numbers are staggering. At the first IRMAA tier, income between $109,000 and $137,000 for a single filer, your Part B premium jumps to $284.10 a month. That's an extra $81.20 a month just for crossing the line by a single dollar. At the second tier, it's $405.80. Third tier, $527.50. Fourth tier, $649.20. And at the top tier, income above $500,000 single or $750,000 for couples, you're paying $689.90 per month. And that's just Part B. IRMAA also hits Part D, your prescription drug coverage. Add another $14.50 to $91 per month depending on your bracket. For a married couple both on Medicare at the second IRMAA tier, the combined annual surcharge is over $5,800. That's not a premium. That's a penalty. And here's where it gets cruel. The trigger isn't your current income. It's what happened 2 years ago. One Roth conversion timed wrong. One home sale. 1 year you took a larger distribution to help your kid with a down payment. That income spike from 2024 follows you into 2026, and Medicare doesn't care why your income was high. They just see the number. Robert, 68, retired engineer, North Carolina. In 2024, he sold a rental property his father left him. The capital gain pushed his MAGI to $180,000, a one-time event. He hadn't sold anything before. He won't sell anything again. But in 2026, Medicare saw that 2024 return and hit him with the third IRMAA tier. His Part B premium jumped from $202 to $527.50 per month, plus $45 a month extra for Part D. Total additional cost, over $4,400 in 1 year. His comment on a retirement forum, "I sold one property, one time, and Medicare penalized me for it for 2 straight years. Nobody warned me. My advisor never mentioned IRMAA." The cruelest part? Robert might have qualified for relief, but he didn't know to ask. And by the time he found out, the window had passed. But if you thought an invisible surcharge was bad, the third change is the most aggressive of all. Because this one doesn't just tax your check or raise your premium. It takes your check directly, up to 50% of it. And there are over 1 million Americans it's happening to right now. Worst change 3, the overpayment clawback. This is the one that makes me angriest. Right now, the Social Security Administration is actively clawing back overpayments from more than 1 million beneficiaries. And as of 2025, the default recovery rate was restored to 50% of your monthly benefit, meaning SSA can withhold half your check every month until the debt is repaid. Let me explain how someone ends up owing Social Security money they never asked for. An overpayment happens when SSA pays you more than you were entitled to receive. Sometimes it's because your income changed and you didn't report it fast enough. Sometimes it's because SSA made a calculation error. Sometimes it's because they retroactively reclassified your benefits after a review. According to SSA's own records, approximately $23 billion in overpayments remain outstanding. That's not $23 billion of fraud. That's $23 billion of administrative errors, miscalculations, and bureaucratic lag, and they want it back. Here's how the clawback works in practice. You receive a notice in the mail saying you were overpaid, sometimes for months or years of benefits you already spent, in good faith because SSA sent them to you. The notice gives you 30 days to either repay the full amount, request a waiver, or set up a repayment plan. If you do nothing within 30 days because you were confused or you didn't understand the letter or you were in the hospital, SSA automatically starts withholding 50% of your monthly benefit. For SSI recipients, it's 10%. And it doesn't stop there. If you're no longer receiving benefits, SSA can intercept your federal tax refund. They can garnish your wages. They can even pursue the debt from your surviving spouse or children who receive benefits on your record after you die. Linda, 74, widow, Florida. She received a letter in February saying she'd been overpaid $11,200 over a 3-year period because SSA had miscalculated her survivor benefit after her husband's death. The error was SSA's, not hers. She spent every dollar they sent her on rent, medication, and groceries. She didn't respond within 30 days because she didn't understand the letter. In April, her check dropped from $1,840 to $920. Overnight. Her comment, "I called Social Security 14 times. I was on hold for hours. Nobody could explain why my check was cut in half. Couldn't make rent. I'm 74 years old and I almost got evicted because of their mistake." Linda is not an outlier. This is happening to over 1 million people right now. And most of them don't know they have rights. Alright, that's the bad news. And I know it's heavy. A 40-year-old tax trap that catches more retirees every year. A Medicare surcharge that punishes you for something you did 2 years ago. And a clawback program that can cut your check in half over a mistake you didn't make. But here's the thing, each one of these has a defense. Each one has a move you can make right now to protect yourself. And that's exactly what we're going to cover. Let's turn the page. Best move 1. The Roth strategy that erases the stealth tax. Remember those frozen thresholds? 25,000 single, 32,000 married? The key to staying below them is controlling what counts as combined income. Here's what most people don't realize. Roth IRA withdrawals do not count toward combined income for Social Security taxation purposes. That means every dollar you pull from a Roth account is invisible to the stealth tax formula. The strategy is called a Roth conversion ladder, and the time to start is before you claim Social Security. Ideally in your 60s, during the gap years between retirement and age 70. During those years, your income is typically lower. You convert portions of your traditional IRA or 401k into a Roth IRA. Pay the income tax now at a lower rate, and then in retirement, your withdrawals are tax-free and don't trigger the Social Security taxation thresholds. Let me give you a real example. A married couple, both 65, collecting a combined Social Security benefit of $36,000 a year. If they pull $20,000 from a traditional IRA, their combined income hits $38,000, well above the $32,000 threshold. 85% of their Social Security becomes taxable. But if they had converted that IRA money into a Roth over the previous 5 years and now pull from the Roth instead, combined income stays at $18,000, Social Security only. Zero taxation on benefits. The savings, roughly $2,800 a year in federal taxes. Every year, for the rest of their lives. The Roth conversion window doesn't stay open forever. The earlier you start, the more you can convert at lower brackets. Talk to a tax professional, not a product salesperson, about building a conversion schedule specific to your numbers. Best move 2. The IRMAA appeal most people don't know exists. Remember Robert, the engineer who sold one rental property and got hit with $4,400 in extra Medicare premiums? Here's what Robert didn't know. There is a formal process to appeal IRMAA if your income dropped due to a life-changing event. It's called Form SSA 44. Qualifying events include marriage, divorce, death of a spouse, work stoppage, work reduction, loss of income-producing property, or loss of pension income. If any of these apply, you can ask Social Security to use a more recent year's income, or even an estimate of your current year's income, instead of the 2-year-old return. Robert's property sale was a one-time capital gain. It wasn't recurring income. While a property sale itself isn't a listed life-changing event, the loss of rental income from selling that property could qualify as loss of income-producing property, which is explicitly on the form. The form is free. You can file it at your local Social Security office or by calling the national line. Processing takes 4 to 12 weeks. If approved, your premium drops back to the standard rate retroactively. But here's the critical point. You have to ask. SSA does not automatically review your situation. If you don't file SSA 44, you pay the surcharge. Period. Beyond the appeal, the long-term defense against IRMAA is income smoothing. That means spreading Roth conversions, asset sales, and large distributions across multiple tax years instead of concentrating them in one year. One big spike triggers IRMAA. For smaller moves across 4 years might keep you below the threshold every time. The 2-year look-back is your enemy. But if you plan around it, it becomes predictable and avoidable. Still with me? Drop a 1 in the comments if this is opening your eyes. The last move, the best one, is how to fight back if Social Security is already taking money from your check. And most people don't know they have this right. Best move 3. The 60-day window that stops the clawback. If you receive an overpayment notice from SSA, you are not powerless. You have rights, but you have to act within specific windows. Move 1, request a waiver. If the overpayment was not your fault, meaning SSA made the error, and repaying would cause financial hardship, you can request a waiver using Form SSA 632. If granted, you owe nothing. The debt is forgiven. You have the right to request a waiver at any time, but doing it within 30 days of the notice prevents automatic withholding from starting. Move 2. Request reconsideration. If you believe SSA calculated the overpayment amount incorrectly, or if you believe no overpayment occurred at all, you can request a formal reconsideration. This must also be filed within 60 days of the notice. During the review period, SSA is required to pause collections. Move 3. Request a reduced repayment plan. Even if the overpayment is valid and you can't get a waiver, you do not have to accept the 50% withholding rate. You can negotiate a lower monthly repayment, sometimes as low as 10% of your benefit, by demonstrating that the full withholding would create financial hardship. Here's the critical timeline: 30 days from the notice date. If you file a waiver request or appeal within those 30 days, SSA cannot begin withholding. If you miss that window, they start taking 50% immediately, and getting it restored takes months. If you receive a letter from Social Security that says overpayment, do not ignore it. Do not panic, and do not assume you have to pay it back. Read the letter carefully. Note the date. Call Social Security within the first week. And if you can't get through on the phone, go to your local office in person with the letter and request Form SSA 632 on the spot. Linda, the widow from Florida, after her daughter found a legal aid attorney, they filed a waiver on hardship grounds. 6 weeks later, SSA forgave the entire $11,200. Her full check was restored. She had the right the entire time. She just didn't know it existed. Here's the bottom line. 3 changes. 3 traps. A stealth tax from 1983 that catches more retirees every year. A Medicare surcharge that punishes a single income spike for 2 full years. And a clawback program that can cut your check in half before you even understand the letter they sent you. But each one has a defense. The Roth strategy erases the stealth tax. Form SSA 44 fights the IRMAA surcharge. And a 30-day waiver request can stop the clawback cold. The difference between the people who get drained and the people who don't isn't luck. It's not wealth. It's knowing these 3 moves exist. If this helped you, share it with someone you trust. Your spouse, your parents, your neighbor who just got a confusing letter from Social Security. Because the system won't explain these rights to you. They're counting on you not knowing. Subscribe if you want to stay ahead of the next change. I put out videos every week that protect your money, your identity, and your independence after 50. Because what you don't know is costing you. I'll see you in the next one.